This presentation is about topic 11, anti-avoidance measure. And the subject of this presentation is comparing tax avoidance with tax evasion and tax mitigation. Tax avoidance, tax evasion, and tax mitigation are three types of tax mitigation. This concept has been accepted internationally in this age. The distinction between tax avoidance, evasion, and mitigation is not very clear. It could be viewed as different levels of the behaviors of tax minimizing in a particular legal spectrum. In this presentation, what are tax avoidance, evasion, and mitigation will be explained at first. Meanwhile, analyzing the difference between them, um, some important cases and legislation about this topic will be interpreted in this presentation, which could be very helpful for people to understand this topic. Tax evasion is the most serious behavior in this spectrum, which is illegal and criminal. In Black Law Dictionary in UK, evasion is defined as the willful attempt to defend or circumvent the tax law for reducing one's tax liability illegally. Evasion will occur when people earn tax income from business but declare a lower amount to IRD for paying less tax, or even do not pay at all. There are several types of tax evasion behavior. For example, people selling goods on trade-me regularly and not declaring their income, or not declaring interest earned from the money that taxpayers deposited in overseas bank accounts. Generally, all examples of tax evasion uh, involved the understating of income. Also, taxes could be evaded by using sham transactions, where transactions would be misrepresented, misrepresented on purpose for reducing tax liability of a taxpayer. For example, a company could ask their suppliers to invoice them at $6,000 for two computers that their company purchased, but the actual price of their computers are just $4,000. The company will acquire more tax deduction through this sham transaction. The tax evasion can make taxpayers go to jail or pay penalties. The distinction between tax avoidance and evasion will be talked later. The mitigation is the opposite end of the spectrum, which is the behavior of tax mitigation that the government allows to carry out. In the Lobby case, the court held that tax mitigation is a behavior that could make a taxpayer gains tax avoidance, which Parliament intends to give. For example, taxpayers request deduction for the money that they donated to churches. Generally speaking, um, tax mitigation is a behavior that satisfies with both the words and spirit of the law, but avoidance only follows the former. However, the distinction between tax mitigation and avoidance is conclusory and unhelpful when it being used for determining whether an arrangement is tax avoidance, as New Zealand Supreme Court said. All the concepts about tax mitigation and avoidance do not include any specific rules that could be used to distinguish them. The Income Tax Act 2007 does provide a definition. However, it is not very helpful. So, how to decide a behavior of tax minimization and tax mitigation rather than tax avoidance is pretty difficult. This presentation will explain and analyze tax avoidance deeply, since understanding what is tax avoidance and when an arrangement will be determined as tax avoidance is the best way for finding out the distinction between tax avoidance and mitigation. Tax avoidance as the middle of the spectrum, which is about abusing the form of tax law for denying the substance. What is tax avoidance? Generally speaking, tax avoidance does not involve irregulating. It's not like either tax evasion since it's not criminal, or tax mitigation because it does not follow the spirit of the law. Many people may think themselves acted legitimately in structuring their tax affairs. However, their arrangement actually contains behaviors of tax avoidance. There are some factors that the Commissioner of Inland Revenue will consider in the process of determining whether an arrangement contains tax avoidance. One of them is whether tax avoidance is the dominant reason for making this arrangement. The economic, the relative, and economic effects of the arrangement, and whether the tax avoidance is different with Parliament's intention. Some tax arrangements that are constantly used by taxpayers, for example, professional like accountants or lawyers, diverting their income from their job through trusts and companies they established for avoiding tax. Or someone make his company to rent his wife's house so the company could treat the rent expense as a deduction, therefore pay less tax. Or people borrow money from his own trust to fund his living. The loans are in the nature of his income, but he does not have to pay tax for it. If ARD funds or an arrangement constitute tax avoidance, the taxpayer needs to pay all tax, penalties, and interest. In some situations, the arrangement made in long time ago. Thus, the amount would be accumulated every year and become very large. It's impossible to display all the tax avoidance cases in this paper, but there are some famous cases which give expression on three classic topics. Uh, they are tax deferral, income splitting, and deduction for depreciation. Tax deferral is about the taxpayers can delay to pay taxes. Um, the typical instance on this topic is retirement plan. An employee contributes his her wages on the employer sponsored retirement plan is usually treated as tax avoidance because the employee will have to pay tax when he or she withdraws this money, and the present value of the amount of the tax he or she should pay on their income is much higher than it in the future. Therefore, it's tax avoidance. There is an important case on tax deferral topic, which is Furnace and Dawson. In this case, the Dawson were operating a very successful clothing business. A company called Wood Bestow Holdings Limited wanted to buy their clothing business, and the price got agreed. In UK, capital gain tax had to be paid on any sale. However, there is a specific rule stated that if the sellers sold their shares in company A to company B, and instead of receiving cash, he received shares in company B, then they do not have to pay tax for capital gain until the shares in the company B have been sold in the future. The Dawson incorporated another company, kind of like Company B, and then sold their clothes business to their new company in exchange their shares of it. Subsequently, the new company sold their clothing business to Wood Bestow Holdings Limited. The court have two options for deciding this case. One of them is extending the principle in Duke of Westminster case, which provided a principle that every person has the right to organize his affair in any legal way minimizing tax. Another um, is uh, the Ramsey principle, and this principle, the taxpayer will be taxed on the actual and real effect of his transactions, whatever how he organized them for tax purpose. Finally, the court chose to use the Ramsey principle in this case. The House of Lords held that the arrangement was made for the purpose of tax avoidance. Therefore, Dawson would be liable to pay capital gain tax because they actually sold their clothing business to the ultimate buyer and received their cash, whatever the cash and their names or not. It's a highly influential case which can be applied for solving all the questions that about direct taxation, especially deferred tax. rather than just be used in the cases that related to capital gain tax. Income to splitting. Income splitting is a kind of tax reduction strategy. People use this strategy when their countries have bracket tax regulations, which allow taxpayers who earn higher income have to pay tax with a higher rate. In this situation, taxpayers could split their income to their family members and then reduce the family's gross tax level. In many cases, the taxpayer is a farmer who established a trust and leased his field to the trust at a very low rental, and he continued to do the farm work in that field as a worker of the trust. The beneficiaries of this trust are his wife and children, so all the money that earned from the harvest is the income of the trust. The taxpayer only has to pay tax for the rental and wages. And this arrangement, all of his family members could enjoy lower tax rate since a higher income has been split in full. The court held the arrangement comprises the intention of tax avoidance, and general anti-avoidance provisions applied. What are general anti-avoidance provisions will be talked in following. Deduction for depreciation is very common in the cases of tax avoidance. There is a very complicated case, Ben Nevis. The case is pretty important to the tax system of New Zealand. Ben Nevis explicitly interpreted the relationship between general and specific provisions. There are two parts contained in anti-tax avoidance system. One of them is a set of general provisions, and another is a group of specific provisions. The specific provisions focus on particular questions about tax avoidance. For example, in section DB57, the people can apply a deduction for the payment that they pay to their spouses and partners. This provision could prevent people give their spouse too much money for the purpose of reducing tax obligations. However, since the specific provisions can solve all kinds of problems, many countries adopted general anti-avoidance rules, which could be very helpful to close the loopholes in the specific provisions. They could be applied to any arrangements that are artificial and have more than incidental purpose or effect of obtaining tax benefits. In New Zealand, the general anti-avoidance rules include Section BJ1, JA1, and YA1 of the Income Tax Act 2007. The facts of Ben Nevis' case are summarized in following slides. Trinity Limit bought a block of land, then selling a license to investors to plant forest on their land. However, the license premium will be actually paid at the expiry of this license, which is 50 years later. The price of this license was estimated with the present value of the trees at the harvest, so it's over 2 million per hectare. According Income Tax Act 2007, Section EJ1, a taxpayer is allowed a deduction in an income year for an amount on account of depreciation for any depreciable property owned by the taxpayer. Also, according Schedule 14, the right to use the land is a kind of depreciable intangible property, so the license premium was a depreciable intangible property and should be depreciated over 50 years. However, the court suspect the business reality of the scheme is abnormal when the Trinity limit only spent $580 for purchase 1 hectare, then charged $2 million from investors for using it 1 year later. The majority of the Supreme Court held since the investor claiming the reduction satisfied with the specific provision, the arrangement would not be tax avoidance and the general anti-avoidance rule, but the owners held the arrangement was abusive, so the deduction should not be allowed. In Nevis, the tax avoidance arrangement is satisfied with specific rules of the Income Tax Act 2007. The taxpayer treated a form of fixed life intangible property which could lead them to plant the forests on the land, so they could enjoy a large amount of depreciation over 50 years. They agreed to pay the license or premium at the expiry of this agreement, which is 50 years later. It's very possible that company can't exist this long, so the taxpayer may do not have to pay in tax. And this situation, the taxpayers only following the words of a particular specific provision, not the spirit of the law. In Nevis, the court made a two-step test for determining whether the arrangement is tax avoidance. The first step of this test is about whether the taxpayers use the specific provision in a right way. The second one is about if they use the specific provisions correctly. Did the taxpayers enacted the provisions in a way that was within the contemplation of Parliament? It's very clear that taxpayers did use Section EJ1 correctly. However, when the court analyzed all the transactions as a whole, they found the provision was not enacted within the Parliament's contemplation. This could be an effective tool to distinguish tax mitigation from tax avoidance. A case about tax minimization that satisfied within this two-step test would be tax mitigation. On the other hand, as the paper has explained above, the main difference between tax evasion and avoidance is about the farmer is illegal and later is legal. As the civil wrong, if the commissioner found out there is an arrangement contains tax avoidance, she could restrict taxpayers' transaction to make the effect of the arrangement to be acted. But in some cases that is very serious, the civil penalties could be imposed. For example, in benefices, a 100% penalty for short tax was imposed by the owner. On the other hand, evasion is illegal and criminal, so the taxpayer may go to jail for it. As the former British um, the Chancellor of the Exchequer, Dennis Doherty said, the difference between tax avoidance and evasion is the thickness of a prison wall. This presentation explained and analyzed what are tax avoidance, tax evasion, and tax mitigation, and interpreted the distinction between them. Some cases and legislations included in this assignment are very important to this topic. They give some effective tool to distinguish tax avoidance from evasion and mitigation. Thanks.